Hello guys. So I would like to talk about the US housing crisis which took place in 2008. So let's talk about the background and causes first. Now investors had their money invested in US treasury bonds and stock markets before the start of the new millennium. So this was during the late 90s. So they were getting pretty decent returns from both. So things started changing due to the dot-com bubble burst and September 11 terrorist attacks in the US. So after that, stock market crashed. It kept going down, and the investors were withdrawing their money. So they went into saving mode rather than spending more. So around the same time, Greenspan, the chairman of the Federal Reserve, the then chairman of the Federal Reserve in the US, decreased the interest rates to around 1%. So why did he do that? He wanted to encourage spending uh, and thereby rev up the wheels of the economy. Now, because of the attractive interest rates, due to the very low interest rates, borrowers start taking loans to buy houses. Okay, so housing prices kept increasing due to this, and this is where exactly the investors saw an opportunity to invest again. Okay, so they had withdrawn their money and they were looking for avenues to invest. So this they thought is a good opportunity to invest. And due to high demand, banks provided loans not only to prime borrowers but also subprime ones. So subprime basically are those borrowers who are more likely to default, who didn't have a proper source of income and all. So the prime borrower generally the banks do verify the credibility of the borrowers, but due to high demand of the investors, they also started providing loans to subprime ones because anyways the loans were backed by mortgages. So they thought that even if there are defaults, they could sell their houses and then recover the money. Okay, so investors started investing in these mortgage backed securities. Now investment banks saw an opportunity too, so they came with a product known as CDO, collateralized debt obligations. Now each CDO is made of tranches of you know safe securities which are AAA rated, OK securities which are triple B rated, and risky securities which are unrated or junk bonds, junk securities. Right? So the thing is when repayments come, safe tranche gets filled up first, followed by OK and risky tranches. Okay, that is how the structure is. Now CDOs are to be rated by rating agencies. So investment banks approach the rating agencies like Moody's, S&P to give ratings to the CDOs. So accordingly, they can sell it to the investors. So the credit rating agencies gave AAA ratings to the CDOs. Okay, despite the fact that there was presence of risky securities in the CDOs. Right. So they did that because they wanted to maintain the business, carry on the business, and they wanted to maintain good relationships. Because if they didn't give good ratings to the CDOs, then the investments would have moved to the competitor rating agencies, and they would have got their work done there. So the rating agencies didn't want this to happen. So that's what. And investors not only in US but outside of it also found these CDOs attractive. So they started investing heavily. Investment banks made huge profits. Okay. So apart from this, think about investors getting insurance in the form of CDS. CDS is nothing but credit default swaps. Okay. So they are getting insurance in the form of CDS for the CDOs they have invested in. Okay. So this means that even if the CDO defaults, AIG will pay them their money. Okay, so which makes it highly attractive for the investors. Okay, so everything was going fine. Okay, this was a structure, this was the process, everything was going fine. Now the rates at which lending was done, okay, for the houses was adjustable, and the adjustable rates kicked in 2007. Okay, rates were increased up to more than 5%. So this affected subprime borrowers the most, and they defaulted naturally. banks tried to sell houses. Okay, if there were a few defaults, then banks tried to sell the houses and they were in a good position. But defaults kept on increasing, and the houses which they had possessed uh, also kept on increasing, right? So the demand, ultimately the demand was less than supply. So what happened? Housing prices crashed. Okay, they crashed heavily. At the same time, the prime borrowers who were regularly paying the money back, okay, repaying the money back, they didn't see any logic in paying more loan amount than the housing prices, because their loan amount was very much high than the price of the houses after they crashed. Okay, so they also started defaulting, and such. This is how the bubble burst. So ultimately, it affected the CDOs which were created by the investment banks, and CDOs were effectively worthless eventually. AIG also began to realize that they have to pay back huge amounts in the form of because of the CDS agreements. So they had, but they didn't have any money because of the defaults. So luckily for them, government bailed them out by giving $85 billion. However, few investment banks like Bear Stearns and Merrill Lynch were not in a good position, so they ceased to continue as independent companies, and they were purchased by JP Morgan and Bank of America respectively. Lehman Brothers, unfortunately, was neither bailed out nor purchased, and they filed for bankruptcy on 5th September 2008. They suffered billions of dollars in losses, and several other financial institutions also went bankrupt. So, as an effect, in US itself, 8 million jobs were lost and 6 million people were homeless. Okay, wealth of pension funds, insurance, real estate, savings, bonds, etc., eroded, and I mean, it was getting really problematic for the citizens. Now, let's talk about the aftermath. So, regulations were introduced because the derivative market and mortgage market was deregulated. So, regulations were earlier. So, regulations were introduced for these industries. Okay, Dr. Raghuram Rajan, who was the then chief economist of, at the IMF, had predicted this crisis at his 2005 Jackson Hole speech. He mentioned about innovation and complexity of financial products, making the financial system riskier rather than safer. Though he was not taken serious initially, during the crisis he did get his due recognition, and but it was too late. So despite the lessons learned, so lessons were learned definitely. As I said, some regulations were introduced. Okay, uh, despite this, large banks started transaction again in something known as bespoke tranche opportunity, which is another name for CDO as per Bloomberg. Which means that after learning the lessons, if we keep going back to square one, then the cycle will repeat. The cycle of crisis will repeat. So there has to be fiscal discipline as far as this particular case study is concerned. There has to be fiscal discipline. There has to be regulations, proper regulations, and greed has to be controlled. Okay, because the effect of the impact of all these things was clearly evident in this particular chapter of US history. So I hope you liked this video. You found this informative. Thank you very much.